Profit First by Mike McCallowitz is a vital business principle, which for a long time I've really struggled to implement. Loads of us get caught up in the growth mindset, got to spend money to make money, and Mike McCallowitz really specifically targets this idea of certainly the sort of startup world where you basically want to be really unprofitable for years and years as you grow, and then at some point you can turn on the tap and switch to profitability. Now, he argues the opposite, that actually that doesn't apply to the vast majority of businesses. There's a lot of survivorship bias. So we might hear about big Silicon Valley tech startups, but we don't hear about everyone else who just crashes and burns. So really, he argues that you need to be profitable from the word go. And to do that, it basically comes down to a lot of personal discipline. Basically, as soon as your business makes money, you want to get that allocated between your income account, profit account, owner's compensation, taxes, operating expenses. So I've just asked Perplexity AI to give us the breakdown and formula, but fundamentally it comes down to the personal finance idea of pay yourself first. So great quote here from the book that really encapsulates that. The old, been around forever profitless formula is sales minus expenses equals profit. The new profit first formula is sales minus profit equals expenses. So logically, nothing has changed, but profit first speaks to human behavior. It accounts for the regular Joes of the world like me. What Mike really addresses here is basically Parkinson's law, where Parkinson's law basically says that work expands to fill the time allotted to it. So you probably know the feeling. If you've got to get something done, if you give yourself 6 weeks, you're probably going to do it in the final week on the last day in about 2 hours. So if it only takes 2 hours anyway, if you just gave yourself until this afternoon to do it, you would probably do it this afternoon. Whereas if you give out a longer time frame, then you end up inflating it. And that gets worse in the corporate world, where you've got all these levels of inefficiency, where someone might have an idea, that then gets escalated, and then let's have a meeting about that idea that could have been an email. And it starts creating bureaucracy. Let's put together a proposal, work out a strategy, all these steps that are not actually just getting the work done. And it's the same thing with Profit First. It's the same thing with your profit. If you set aside the figure that every single month you're committed to putting away, you're much more likely to make it. Now, I tried it, and there definitely were times I had to keep on digging into that profit pot, and I was failing to actually put aside anything away. But that's so much better than keeping it open and saying, let's spend what we like, and then what's left over goes into the profit pot. Let's reverse it. We'll prioritize profit, and therefore we're much more efficient with the budgets that are left over. If we find we've only got a set amount of money to spend this month, we're probably going to spend it much more efficiently. And I've definitely found that. Whereas a year or two ago, I was going for every opportunity, whether it was new tools, new subscriptions, paid ads, in-person events, masterminds. Whereas now I've really stripped all of that out and really only spend on a few fundamentals. So yes, you still have to spend money to make money, but I'm a lot more strategic about it because I'm limiting my resources. Because if you limit your resources, you tend to have to think much more creatively and much more strategically. So as soon as you get money in, it is very tempted. Me especially, I'm very tempted to just blast that on new revenue channels, try and grow faster. And what that then happens, you just end up on this hamster wheel where you're never actually keeping anything back. And it's a very dangerous situation to be in. I've done this countless times where just recently I've only just paid off a balance transfer credit card, which I used to buy a load of expired domains from Odus Global a good few years ago. So I got 2 years interest-free credit, and that was great. But of course, taking high-risk punts like that, you're basically just stalling the payment, and there's always going to come a time where that debt is then hanging over you. So I've grown both my websites, my agency, very aggressively over the years, and the result has been this really quite stressful effect where I am spending exactly what I'm making, chasing to make credit card payments, and really you're only just one mistake away from failure. I just recently tried to buy a McLaren. Obviously we know everyone's buying these cars they can't afford on finance, so surely I can do the same. The dealership put through a credit check and the finance provider said, no, I have been too aggressive with loans and credit cards in the past. I have a profitable business, but they don't care because they can see in the past I have been overutilizing credit. Just a few months ago, I landed in Romania only to immediately get a text message from American Express saying they have literally just halved my credit limit because for too long I've been overutilizing my credit. Even though I'm paying it all off, the overall utilization was too high. And so because of that, they were going to cut the amount I could borrow. And I'd already borrowed that half. So from the moment I landed in Romania, I had to rely on cash. I was no longer allowed extra credit. So do I regret it? Not really. I'm a big fan of leveraging credit in order to grow. but I have probably pushed it too far. Had I implemented some of these profit first principles a lot longer before, I could probably still have a very healthy, profitable company, but I would also have a healthier credit rating, and I would have got my McLaren. So certainly recently I've got a lot better at implementing profit first, and I'm going to give you some of the methodologies I've used to actually make that happen. Now, in my mind, profit first is difficult because you do need to spend money to make money. You have to start somewhere. This was a website I sold a couple of years ago, and I scaled it to a reasonable monthly income and was able to sell it for 43 times its monthly revenue. Now, I pushed for a higher sales multiple on Empire Flippers, and therefore it just sat on the platform and didn't sell for a long time. I was getting offers in for a lower multiple, but I wanted to wait. I was not desperate to sell. When I started my link building agency and witnessed my sites just exploding in traffic from building high quality backlinks, I then realized I had this really good asset where I hadn't built any links. So I really wanted to find out what happens if I did build some links for that site. Could I then massively scale that potential sales figure? But as soon as I said to Empire Flippers that I was considering taking it off sale, I had a buyer reach out to me willing to pay the asking price. And he also said that he'd actually very interested in my link building service because he was keen to grow this website. But as soon as he took over the site, he told me very clearly the website, the asset had to actually pay for itself, pay for the initial investment before he could continue investing in it, which on one hand seems very sensible. But as we can see here, he didn't really do much with the website. Certainly, once I sold it, it seemed to carry on to a new high. And I certainly had the seller's remorse that I could have been making a lot more money in that time. And hopefully he did actually make back his principal then, and then some. But very quickly after that rise, it started to tank. It was up and down a bit, and now it's almost fallen off entirely. And as far as I could see, monitoring the website, they didn't actually do anything with it. They told me they changed the hosting, but I didn't actually see any changes in terms of the content, the backlinks. They did not give the site the full attention it needed to thrive and survive. So this is just a counter argument to profit first, where once he bought this asset, I really would have doubled down on actually scaling it and getting some protection in there. So hopefully in that time it did pay for itself, but equally, at the same time, there is a risk that if you don't spend, you're not going anywhere. But the key point with profit first is spending measurably and with discipline. So Mike McCallowitz does give some examples of how you actually might want to break this down. So some people will say that 10, 20% of the income, that should go straight to them as owner's compensation. Of course, tax is really important. It's very easy to get into a state where you've completely forgotten about tax and you've had your most profitable time ever and reinvested that money, only to find very quickly that you actually owe a really big chunk of money. So that can be very difficult. So Mike McCallowitz basically talks about having these different pots, and the idea is that your income comes in and you divide it amongst these pots. And what this basically does is it gives you effectively budgets. So you can still advertise, develop, scale, but it needs to be within that budget. And that should be a much safer, more secure way of actually growing your business over time. Now, as I've said, I fought really hard to actually implement this, often very unsuccessfully. I am too undisciplined, too tempted by shiny objects. I always see this next big thing where I could potentially 10x if I'm willing to just have this punt and gamble. But I will say that ever since implementing the steps I've now implemented, I sleep a lot better. I feel much more rested when I'm not dealing with this big credit card bill at the end of the month that's going to wipe out all my earnings for that month. So the most important step to actually implementing all this is basically having a bank account that actually supports these kinds of jars, because you don't want to be opening accounts all over the place. So in my case, I actually use Wise, because operating in different currencies, for one thing, we're making expenses buying links and reaching out to webmasters in all kinds of different languages. So it really helps to actually keep those currencies localized. So most of our expenses are in US and most of our clients pay in US. So for that reason, we don't want to lose out on conversion rates. So we want to keep everything in dollars. But equally, we've had clients in various parts of Europe, other languages, and other currencies. So Wise lets me keep currencies in a very efficient manner whilst getting a really good exchange rate. But Wise also lets you set up basically jars, which are literally just mini sub-accounts within Wise. So I basically set up a profit account both for USD and GBP. So basically that means I can take this set percentage every month and transfer that into these jars. But here's where it starts to get interesting, and something that Mike McCallowitz doesn't actually talk about. With Wise, I can take that profit jar, which naturally accumulates over time. And my biggest concern with holding on to cash is always inflation. The reason I've been so bad with profit first is as soon as I make money, I get into this position where I'm thinking inflation is going to chip away at this over time. And there's also opportunity cost. If you're keeping money as cash, a bit like having it stuck in a property or something like that, then there's always this opportunity cost that there's higher growth opportunities out there. And if it's just sitting either as cash or in a low return asset, then I'm missing out on really good growth every year. So this is why lots of extremely high net worth individuals will actually refinance their assets like property, cars, things like that, basically taking out loans against it, because the loan interest might only be a few percent, 4 or 5%, something like that. Meanwhile, they can invest that cash even in just a simple S&P 500 tracker and make an average of 10% a year. Now, that is leverage. It is quite dangerous. I know someone who has done this. They had a property in London and a country property and basically took out loans against those properties when we were in historic low interest rates, completely forgetting, well, there's no forgetting involved. There was just a lot of unforeseeable events that happened in that time. We had the global pandemic, and then Russia invaded Ukraine. So massive global pandemic, plus war in Europe, two things that could not have been predicted 3 years before. And so because of that, they've now had to liquidate those assets in order to pay off those loans. So a dangerous situation to be in. However, it remains that if you've got the profit jar in your company, then that's going to be losing value to inflation over time. And what's more, there's always that sense, especially if you've got entrepreneurial mindset like me, if you've got cash sitting in a pot, you want to do something with it. And that's why I'm always investing it and spending it. And the result is I never actually have a tangible profit I can just sit on that's secure. So the answer for me, at least, was the fact that Wise actually lets you invest in stocks. So basically I can take my profit jar, both the GBP and the USD one, and it gets automatically invested in the iShares World Equity Index Fund, which tracks the MSCI World Index. And if you track this over a long period of time, remember, all investing is a long-term process. You've got the peaks and the troughs. But generally with these indexes, you can track them over a long enough period of time. Yes, there have been massive falls, but if you take all those into account over a long enough time frame, you'll generally see a return of somewhere between 10 and 12% per year. So because of that, I'm now much more motivated to actually be disciplined in holding on to a profit pot, because that profit pot then goes on to make truly passive income. I've got this big pile of cash in my bank account, which is my safety net. It's there for anything that might go wrong. But now I also know it should be safely accumulating around about 10% a year. Not guaranteed, but that's the average we should expect. The limitation of that is, of course, you are still susceptible to changes in the stock market and world events. So in my case, I'm now looking at alternative assets to try and hedge against things like, what if there is another pandemic? What if China invades Taiwan? These kind of really catastrophic events that really could have a big impact on the stock market. But at least for the purposes of my profit pot within the business, this is a really good start that's motivating me to keep back that profit every month, because I could take a wild punt on a new revenue channel, or I could just set aside some percentage for that revenue channel for a sort of advertising and growth fund. But meanwhile, the rest stays in profit and it gets invested for a return of approximately 10% per year. Now, I've only been doing this a few months, but I've already made a very good return on that. And it is so satisfying knowing that I haven't really had to work for that actual stock return. I've had to work really hard to actually get that profit pot built in the first place and keep contributing to it every month. But the fact is those returns from the stock markets are entirely passive. What's more is it's using the World Index, which is a highly diversified ETF. So it's taking an average across hundreds of different stocks rather than just picking a few stocks where we don't know what's going to happen. So you could very easily find yourselves out of pocket. Instead, the great thing about index funds is they're self-filtering. So generally they'll take the top 100 or the top 500 companies in an index. And if the company underperforms, it just drops out of the index. So they just keep a snapshot of the best performing companies at that particular time for that index. So ETFs are widely known as generally the best stock investing strategy. While there's always outliers, most people are unable to actually outperform the market. So just track the market. You'll save so much time versus going deep into stocks. I've done it before, trying to pick individual stocks, looking at PE ratios, things like that, earnings reports, and you're just not that successful and you spend a lot of time doing it. So much better, I focus on my business, where I can make these huge returns, save them into my profit pot, and then they get passively invested for around about a 10% return per year, which will also compound. So you'll be making 10% on each 10% you make. This is all ring fenced within the company as a business, therefore still liable to corporation tax and things like that, but at least it stays within the business. It's only that corporation tax rate rather than taking it out where it then incurs my personal tax rate. Now, the only downsides I can see with this strategy so far are that, first of all, yes, it is still stocks. So there is still that risk of a world event causing some turbulence. That pot could entirely go to zero potentially, as can any stock market investment. But the more concerning thing for me is actually the service fee. So generally, ETFs are really, really cheap. We're talking a fraction of a percent in fees because they're passive. They don't need a fund manager. Whereas, of course, Wise, for providing the service, do charge their own fee. BlackRock has a bit of a fee as well. So for the UK, the service fee is 0.4%, which might not sound very much, but actually you can go away and do your own research from the investing gurus, but basically a 0.4% fee is actually quite significant. When you factor that into compounding, it can really add up over time. Because if you've got £1 million invested and that goes up by 10%, but 0.4% was taken up by fees, that can really add up. Stretch that out over a 10, 20, 30-year timeline, and you're paying a lot in fees. But for the time being, I'm happy paying that fee because it keeps it all within the Wise account. To do anything else, obviously take some work with my accountant to say it's going from this pot to this investment pot, and that will take some management. It's also likely that any platform you use for investing your company profits in the stock market will still have their own fees attached. One alternative I found was Interactive Investor, at least for the UK, and here we have an additional monthly charge of £30 to cover operational costs in maintaining services for company accounts and trust accounts. So no matter how much you got in there, it's £30 every month. So the Wise 0.4% isn't brilliant, but I quite like it because it's all integrated within Wise. So payment comes in, we divide that between operating expenses, advertising, things like that. But then I have my allocation that every month goes into the profit pot, and that instantly goes into that 10% a year average, not guaranteed return. And all it cost me is 0.4%. So if you're anything like me, I'm sure you'll agree, it is very appealing to stretch that out over 2-3 year time span. My agency is growing all the time. My affiliate revenue is growing all the time. But what if all of that is just paying into a bigger pot, which without me doing anything, just in the background, is ticking over, generating approximately 10% per year. That's much more appealing than what I was doing before, basically burning cash, testing out all sorts of different ideas, different channels, and just generally getting confused. I really like Hormozi's advice. You want to stick with one product, one channel, and just stick with that until you hit 7 figures, and only then starting to look at diversifying your channels. So in my case, I'm going hard on YouTube, hard on my agency, hard on affiliate. So my costs to actually acquire a client are very low. Therefore, everything I would have spent on ad spend goes straight into my profit pot, and that's gently growing into a really big, safe nest egg that's going to generate a consistent return over time. So it's perfectly plausible that at some point in the future, I might dial down client work and still have this asset appreciating in the background without me having to do anything. But in the short term, it means any problems I encounter in the short term, big changes in the SEO world, perhaps all my clients left, something like that, all these unforeseen things we can't fathom, I should still have a good year or two of operating expenses saved away in the background. I can take them out of the investment pot. It only takes a few days to turn those stocks into cash, and then I've got a safe runway to see us through to when we're profitable again. So this is what Mike McCallum explains in his books, that if you're taking this sort of fast-paced churn approach where you're literally investing everything, then you could so easily get into a situation where your income drops and you don't have the backing, you don't have the runway to see you through that downturn, see you through that turbulence. Whereas if you've got a cash pile, you can basically self-fund, take advantage of that change in the market. You'll probably get a load of opportunities coming there from people who don't have that cash runway, therefore having to sell off their assets. So other service providers might go bankrupt. You can basically get their clients, any other assets or properties, things like that. They'll get sold in a fire sale while you've got cold, hard cash that you can go in and buy those up at a discount rate. So having that, generally, I like to go hard and aggressive with a lot of business, but having that cash pile, having that nest egg is a really good self-insurance policy to get you through downturns, but also capitalize on those downturns as well. But in the meantime, I put into stocks to motivate me and give me a solid return without me having to do anything.